Hey everyone, so I wanted to do a quick video to help educate, and this will go on my social media. It's also going out to my client database so that you guys are aware of what's going on in the market so you can prepare for refinancing or selling or buying in 2024 if that's on your plans. So, why have things started to rebound, and what hope is there in the market to help with showing you why rates, and everybody is talking about rates coming down in 2024. So, as you can see, this chart shows you the market, and this is the last 2 years. So, you can see as this goes down, rates go up in 2020, in October 23rd through the 26th, rates were at the highest they had been since, you know, really the 80s and 1995-ish, but we were close to 9%. But the market since then has rebounded over 500 basis points, bringing rates from 9 down to about 6.875, 6.5 roughly. It's huge. And the reason why that is happening is inflation numbers are coming down. The 10-year treasury is coming down. This was near 6%. If the lower this number is, the lower rates are. The higher this number is, so the lower this number is, the lower rates are. The higher this number, the lower rates are. This is an inverse relationship. And so I want to show you data that in this email and or in this video. If you didn't get this via email, you're just watching it on my YouTube or TikTok, go to this website address right here, and you can look at the historical releases of CPI, Consumer Price Index. You want to click the PDFs because that's the most efficient way to read them quickly. But let me just show you the report that came out in January on the 11th. That's replacing the December of 2022's numbers with December 2023's numbers. So it's updating the chart. And so what you're seeing here is the data that we're replacing is coming down. And so that's why it's so important to continue to watch this trend, because as we get into January, that's what I want to focus in at. Because see, we were this report, the 2023 that just came out in January, was replacing the December 2022's numbers with the updated information, because that's how those reports work. When December's came out, it was replacing the November of 2022 with November 2023's numbers, and so forth. And so we look back here to see what numbers are going to be replaced in January. So in January of 2023, this number was again 6.5 and 5.5 when you're looking at all items and then items minus food and energy. Now the numbers are in the threes and low and high twos. So we're going to be cutting this in half. And then when February's report comes out in March. So again, as the reports come out, it's replacing the month before's data with the current data versus the year before. And so February's report, when it comes out on February 13th, is replacing the January's numbers from 2023 with 2024's numbers. As we can see, this is January 2023. The numbers were over 6% and all in over 5, almost 6%, which right now the numbers are 3.2 and 2.7 roughly estimated for the numbers. And then so when March's report comes out on March 12th, that's replacing the February 2023 with 2024's numbers. February's was over 6 as well. And then as we go through that first quarter, April's report is going to replace March's numbers. And again, we're starting to come down, but we're still above 5 and still right at 5, but it's going to be in the threes, low 2 or mid 2s. So we're getting back to the Fed's favorite target, which is sometimes crazy, is inflation at 2%. And so we're starting to remove all of the data that has any kind of reporting that inflation was up over 6% and 5%. But as you watch these things, as we progress through the year, that's why as we get through the first quarter and into the second quarter, rates should rebound. And the Fed is talking about cutting their Fed fund rate potentially 6 times next year. And as you can see, we had a drop because the economy was recovering. Everything was going well in 2023. So the numbers were coming down. And again, you'll see, but then we had a little bump up And that caused some rates to start climbing. And as you see, we had to level off in order to start coming back down again. But this is the stuff that I'm talking about and why it's so important. Go to these websites, click the data. It is important. And this is going to be a little bit longer, but it's an educational video so that you are aware of what's going on in the market and why. So let me give you an overview picture, because some people in the media who are paid by engagement wanted to make this big comparison of what we went through in 2023 to what happened in 2007 and 8. And I want to show you and empower you on why that is not a good comparison. And it starts with data instead of emotions. Here are the facts. There's two things that keep in mind: home completions and home formations, or housing completions and housing formations. Housing completions are homes that are completed and built, and housing formations are people entering the age to get a house, which typical average is 33 years old. So what this is big about is look at 1973. So when 33 years old in 2006, that's important because it started the decline for the big, huge crash in the market, 2007 through 2011. We'll look at it because it's a decline here. There was a decline the next year, decline the next year, decline the next year. And then we started to bump up, level off. But I'm going to show you what that did versus the, with the supply and demand curve and what we failed and why we won't have that scenario again. Versus, again, in 2023, 33-year-old in 2023 was born in 1990, a huge jump in population. And you can see through generations of 55 million Gen X and 66 million in the millennial generation and 61 million in post-millennial. So we have a huge demand pushing the market and not enough homes being built. And let me show you what that looks like. So why it's so important to invest in a home: you get your home increases in value. As you can see, this is home price appreciation rates since 1942. This is huge. As you can see, every year, home prices are continuing to go up exponentially, even through recessions. We know there's recessions in the 70s, the 80s, even in the highest rates. In 1983, rates were almost 20%. Home prices still rose 5, 7 throughout that time period. We had a small dip in 1990, 1991, but not much, especially if you consider all of this appreciation. Now, this is where most people are terrified. Builders are terrified because look at this home values dropping. This is something that's crazy. But when we go back to data, why did this happen? So we start looking in 2004, before the crash in the market. You see formations. Remember what I was talking about? This is the people that are entering the age to purchase a home. It is less than the completions, homes being built. Remember, the United States, capitalist society, and supply and demand is a real factor on pricing. So when you have less formations than you have completions, that should be an area of concern, but it wasn't addressed because lax lending guidelines, and there's just craziness going on. If you haven't watched the movie Big Short, I highly recommend it because that is exactly what was going on back then. If you could fog a mirror, you could get a loan. They had stated income, just garbage. And it set us up for failure, especially when you look at data. Formations, right here, under completions, way under completions in 2006, with a huge drop in population again, because why? There was that drop in population. Of course, formations are going to be way lower than the average because we see it, but we can look at this stuff. Data is right there. But if you watch, completions still outpaced. And now, of course, we have the crash that happened and home values started to plummet. But if you look, the completions still were outpacing formations for a while. It starts to level off. Then all of a sudden, mid 2012, starting to get into 2013, we're getting back to getting some completions versus formations, but then massively, a little bit in 14, 15, got a drop here, but 17, 18, 19, 20, 21, 22, 23, formations have outpaced completions significantly. That is why prices continue to go up, is we have way more demand than we have supply. And right, for a stable housing market, should have about 4 to 5 months of inventory available. Right now, there's less than 1 million homes available. And that is terrifying because between those time periods, we have 11 million more buyers in the market with 3 million fewer homes. And when you look at the completions, there's like 1 million available, but almost half or over half are already under contract. So there's only like really 400,000 homes available to purchase. Now, January, starting in the last quarter of the year, it always starts, the market slows down because kids are in school, there's holidays. But then as the first quarter happens and then we start to hit spring break, that's when the markets start to go nuts. And that's why I want to educate people now, because if you've been on the fence and you've been thinking about buying a home and you're like 2024 is the year, get with me, get with your loan officer, get with a local licensed residential mortgage loan officer to get a game plan to purchase as soon as possible. Because right now there's still seller concessions. There's still, sellers paying title. Most people aren't having to bid over list, but buyer activity has picked up because for every 1 point drop in rate, prices start to go up about 3 to 5%, and it brings 3 to 4 million buyers back to the market. More buyers, more demand, less concessions from sellers. And so that is huge because 2020, 21, most people are like, oh, this is not sustainable. Look at what happened. Home prices went up 10%, 19%, 6%. So they were like, this isn't sustainable. But it isn't the only time in history where we've seen home prices go up exponentially. And so that's why when this turns and rates start to drop again and we get back into the 5s and 4s and you can buy down your rate even lower, people that felt trapped in their home because of credit card debt, but their home mortgage was 3% or 2.99 or, under 4, they were like, man, I've racked up credit card debt, but I can't sell because my home, the rates are too crazy. Well, when that balances out, equity gains have been insane for the last few years. So they're going to be cash rich, meaning when they go into the market to buy their next home, because they can sell their home, pay off all their debts, make sure they're in a better position, get out of the COVID funk, move into 2024 with power, and take that equity. But that means that they'll be cash rich and able to bid over list again, like we saw in 2020 and 2021. And that's the part where we want to get ahead of that. And especially for like the first time home buyers who don't have all that cash, we want to make sure you're set up for success. And if we get a game plan in place now, it's going to help. But that is why I wanted to make sure I educate the people that follow me and show them why the prices for homes are not coming down, why it's nowhere near what happened in 2007 through 2011. You have the data. You can go on Case-Shiller. You can go on the BLS, which I showed you on the CPI report. You can pull all of this to confirm. But I did it for you, and MBS Highway put together this amazing slide so that you can see it, facts over feelings, and make a good decision for your current and long-term financial success. And here's the release schedule for CPI. CPI is a good measure of inflation. That's Consumer Price Index. PPI, Producer Price Index, is huge. And the Fed's favorite measure of inflation is PCE. But like these right here, check the date, save it so that you can track this as well. I'll keep you updated and make sure that you're empowered buyers and sellers and refinance. But for my sellers and my people that are thinking about refinancing, I wanted to show you this illustration because there's going to be marketing attempts that you're going to get inundated with as rates come down, because you'll see lender shops pop up to take advantage of these windfalls because they'll buy a bunch of data from the county to market to homeowners. And so they'll blanket you with a bunch of stuff. If you were in the 7s, they'll be like, oh, we can get you a rate of this, 5.5. And you can see the payment difference. Say you have a $300,000 house, and this is for principal and interest only. Say it's a 6%, $17.99 a month. Well, if they're like, oh man, we can get you to 5, it drops it to $16.10, which sounds amazing. But if you are following me and you know what's coming up, not saying nobody can predict everything perfectly, but when you have data, science, facts, history, you can look at opportunities to maximize your return. And so I would say, reach out to me. If you get an offer from somebody, contact me. Let's make sure it's right. And let's make sure you're actually doing it at the right time and not leaving money on the table. Because if you refinance to 5, if anybody tries to get you to get it to 4, that is stealing your money, in my opinion. Yes, it helps drop your payment for the 300 from 1610 to 432 to 1432. But there needs to be questions. How long do you plan on owning this home? Are you planning on selling? There's a ton of those, because if you don't want to churn your loan. Because what if you'd have just waited a month and now you could have got the 4 and you don't have to pay, because they'll roll in the costs. They'll say, oh, it's no out of pocket. The costs get rolled into the loan on a refinance. So I just want to make sure you're aware and an educated and empowered consumer. This is your chart. Save this information. It's principal and interest only. And so you want on a 30-year fixed loan, so you can kind of see the scale to see when it makes sense and what the numbers will do when you go to refinance. And it's huge. But this also helps illustrate, why did the median home price, which is not home values, but it's the median home price, drop in 2023? And the media covered that like crazy. They didn't cover the home value appreciation. They covered the median home price decline. Well, if you were trying to buy a $600,000 house and rate and the payment's $4,525, and that's just principal and interest, compared to when rates were here, that is a huge difference. So of course, people that were in the homes that were 600, 700, 800, 1 million, 2 million, they weren't selling because the payment would be astronomical. So of course, the average sale price is going to come down on homes, but that doesn't mean that's not a correlation with the home value. And that's why I wanted to make sure you're educated, so that you're not listening to these buzzwords that get clickbait and engagement by a media that's not paid to necessarily to give you honest and true information. They're paid to get engagement. And that is not what I'm here for. I'm here to educate, empower, and break chains off of people that were held by the people that benefit from you being ignorant and not owning. Because if you own, you increase your net worth through forced savings, through principal balance reduction, because every time you make your payment, a portion goes to principal, reducing your balance, creating equity, and through appreciation. And if we go back one more time to the chart on appreciation rates, since 1942, owning a home is a long game. If you're paying rent, you are paying a mortgage, it's just someone else's. Some people wait to buy because they're like, I don't know where I want to live for the next year. I might move in 2-3 years. So they'll rent. Well, that is what's keeping a lot of people back from really having financial liberty and success. And when you own and you have equity and you have money, that's also power. And so I want to empower you to change your future. This is what this is for. Check out these numbers. Go to Case-Shiller. Get the home price appreciation rate since 1942. It's a chart you can get. It's beautiful. But here it is right here with highlights to let you know the difference between 2007 through 11, why that happened, and why that is not going to happen again, because you have the data now. You can see that formations have outpaced significantly completions for a long time. And that is what's going to cause these home values to go up. That's going to be great for owners, but that's what we want to make sure we get ahead of for those first-time home buyers. And also to think outside the box, because a lot of first-time home buyers don't think, especially if they just graduated high school or college and they had an okay job and they're like, I'll pay rent. Well, what if we could help you find a condo with the same equivalent payment? You stay in it 12 months, you can use that as a rental property in the future, or use the equity you gained to springboard retirement, pay off debts. But look here. This is amazing. America's housing market has been an amazing investment. And I saw a video or a TikTok of a person the other day saying, your house is not an investment. I laughed, because that mindset is absolutely toxic, because if you're going to have to spend money to pay rent or a mortgage, right? Paying rent is 100% interest, and you have no forced savings through principal balance reduction. You have no tax benefits. There's nothing. So that money just goes away. And so some people are like, well, it's just $2,000 a month or whatever the average rent is. Well, that's $24,000 a year, but you also have to consider the appreciation, which is an opportunity cost. Because if you didn't get that appreciation, not only did you waste the $24,000 if you had the equivalent payment, you also didn't get your home value appreciating at 10%. If you bought a $300,000 house, your home went up $30,000. So that means not only did you lose 24, you lost 30,000 in appreciation, making a total cost for 1 year of not buying $54,000. Then if you would, the next year, 19%. So we went up 20%. That most people saw their home values go up over 50% collectively if they bought in 2019 through where we're at now, and even more. I don't want to see people lose out on this opportunity if I can help it. Hopefully you found this valuable. If you have questions, let me know. Feel free to click the link in this video to, if you got this via email, to schedule a time to meet with me. If you're a realtor, let's talk. If you're a client, let's talk. Get you on a game plan for success in 2024. I hope you love this. Let me know. Talk to you soon.